Good morning. Thank you all for coming. I'm Tom, I chair the FutureGen committee. Quite a lot of new faces here, which is quite nice, so thanks all for joining. This is the third in our series and the final part, which was an intro to funds. So giving a bit of a high-level overview to the fund structures that we're probably all working on. We've got some great speakers, the two gents joining us from Aberdeen, Neil and Ed. So these guys are going to talk us through the product, a bit about deploying it, some of the investor needs, interests, and so on. As usual, we've got Slido, so anyone that's not used this, you can just go onto slido.com. Alex is going to give us a bit of housekeeping in a minute, so some Wi-Fi details and so on. And using Slido, we'll do some polls so we can get a bit of interaction throughout, and any questions you've got at any point, fire them through and we can get them answered. Andrew is also here from Carey Olsen. Andrew's a partner at Carey Olsen in Guernsey, who's going to give us a bit of a legal overview at the end. So yeah, that's pretty much it from me. I'll hand over to Alex, who's here from Cass Business School, who are kindly hosting us, and enjoy the seminar.
Thank you very much indeed, Tom, and welcome to those of you who haven't been here before. I'd just like to say a couple of words. Firstly, in terms of housekeeping, in the event of a fire, there'll be an alarm, and we just congregate in the reception by the receptionist, and then we'll burrow through the stairs and go down that way. But there'll be a fire warden who'll come out magically dressed with a yellow high-vis jacket in that unlikely event. So we just congregate in reception. Secondly, in terms of Wi-Fi, obviously for Slido, you want to go on to City Guest. I did have the password up here, but it's actually over here as well, and I'll read it out to you. It's VIDZYAA4. So for those of you who are not on it already, that's the Wi-Fi code, and it's up there. So a quick word about the Cass Real Estate Research Centre. We set this up back end of last year, and we really had sort of four objectives. The first was to produce some reports, and we're doing a couple with the IPF at the moment, on areas of interest, be those sustainability or size and structure of the market, etc. But the second objective, and that's really why we're here today, is to host these sort of events on topical issues for the industry. As we said, as Tom said, this is the third in this series, the fourth we've done with AREF. We've also done with ones with the SBR, and we've also done events on sustainability. So it's not purely fund structures and the investment side. We also like to go on to other areas. But if you have any ideas, then please do contact me. We do standard academic papers, which I'm sure you'll love reading with great relish. And in particular, we also do executive education. So again, if any of you, we have got quite a few courses lined up for people. If anybody is interested in that, then please contact me. One of the things to say finally, if you'd like to keep in touch with events, they're not all hosted here. Some of them are hosted over at Bunhill Row. Then please sign up to the mailing list, which is on our website, and you'll be kept in touch with details. So thank you very much indeed for coming. Welcome to Cass. And without further ado, I'd like to hand over to Ed and Neil.
Great, thank you very much. Hi guys. You can read the note. Right, so as you can see, my name's Ed Crockett. I'm head of residential investment in the UK for Aberdeen Standard Investment. My background is a chartered surveyor, and I've been in fund management for about 13 years. What's more relevant to our discussion today is that in the last 3 years, I've been involved in the inception, product development, launch of 3 funds, which have collectively now deployed over €1 billion into the markets or their relevant markets, and that's bringing now in annual fees for Aberdeen Standard about £10 million per year. So that's the context of my role. And this is Neil, who's the brains of the outfit, who works in product development.
My name is Neil Meikle, and I head up the real estate product strategy team. So what does that actually mean? It's my job to design and launch new funds for Aberdeen Standard Investments, and that can be anything from value add funds to residential funds. It can be UK, Europe, North America. We're doing a lot of stuff in Asia at the moment, which I'm having quite a lot of input into. So I guess the point of today is to really show you guys how we look at it from our perspective. Why do we launch funds? What do we look at when we're launching those funds? And eventually, how do we actually deploy that money in the market?
Yeah, so we're not going to cover all the nuances, but I guess what the aim is to highlight the headlines about how you take that seed of an idea to get it through to being a fully established fund. So this is obviously a series talking about funds, so as long as we clarify what a fund is, I'm pretty sure this question's been asked in every single one of the talks or discussions. And if you're really smart, you'll have read ahead in the papers and the answer's on the next slide. So kind of defeats the object. But the idea is to get everyone using Slido, which I guess if those of you who've already got or downloaded, the reference is #FL3. So if you go on there, I don't know exactly how this works, but you should come up with some multiple choices. So a fund is when multiple clients pool in a structure to invest in multiple assets. That's generally what we're talking about today. If you have a single client investing in multiple assets, that's generally a seg mandate. If you have multiple clients investing in a single asset, that's more likely a syndication or a slightly different structure. What we're talking about today is how you launch a product where you have multiple investors investing in a fund that has multiple assets within it. So of those three constituent parts of the ingredients that go into your recipe, which is the most important element that you think you should consider when you're going through that product development stage? So the question should be, is it the clients, the structure, or the asset that is the most important part of those things?
Yeah, there's different viewpoints depending who you're speaking to, who thinks the most important thing. If you speak to the fund managers, is there any other fund managers in the room? So only a couple, so I can generally slag you off. There's a very different perception from a fund manager's perspective in what's important in a fund. Effectively, at the end of the day, they want to be able to buy the assets and generate the performance for the client, but there's a long way to go. And one of the questions I always get asked, and Ed always tries to pin me down on, how long does it take to launch a fund? If you've got the money, you've got the client, and you've got the idea, you can do it very, very quickly. In fact, the longest thing when it comes to launching a fund is often opening the bank accounts and going through the KYC. Okay, so it's not a question of how long it takes, it's just about lining up the different aspects that we need to be able to launch a fund, and we'll come on to that in a minute. And that's all I've got to say until you log on to Slido.
74% of people
Perfect.
say the client is the most important.
Well, you've all read ahead in the slides, that's good.
Yeah, okay, so congratulations, 74%. Quite interested.
What did the other 26% say?
Fees, no, it's really important. It's the unspoken
the 26%
part.
Can't read. That's perfect. Good.
Yeah. Okay, so you're right. It is the client. The reality is that all of these things need to come together over time. We talk about how you balance different parts of the product development process. But if you get this bit wrong, you are dead in the water, and there's no point even trying to put forward any kind of strategy that doesn't have at its very heart the client. So, what do they want?
What does the client want? The client wants everything. Okay, they want a strategy that's a sure thing and it can't fail. So they don't want something that they're going to turn around in 5 and 10 years' time and say this hasn't worked, it hasn't delivered what you said it was going to do, returns are below target, it's missed its benchmark. They're not interested. They want something that's going to perform every single time. And then when they go up, and when your fund manager or your allocator within the client goes up to their investment committee and they pitch it to the investment committee, it's got to be a surefire thing. And we'll come on to some of the thematics that are really resonating with people at the moment. Who do they want? Is this relevant for you guys? Marvel's superheroes? If you're doing it for my age group, you'd say Paw Patrol. Probably doesn't mean anything to you. They want a superstar fund management team with a track record decades long that's never failed. You can't always get that. It's quite difficult. So you've got to make sure the team in place has the experience. The resource is the most important thing. Okay, they've got to be able to just do what fund managers do, which is allocating money across assets. They can't be sitting there sorting out the client servicing aspect, sorting out the accounting aspect. You've got to have a team that has the time and the resource to do the jobs allocated to them. Returns guaranteed. As I say, they're not interested in anything that's varied. They just want it to do. If you're saying the fund's going to do 6% and 4% of that's income, the fund's got to do 6% and deliver 4% income. You quite often, if you're launching a pooled fund, a core pooled fund, you're not going to get any extra fees. You're not going to get any extra kudos if you hit 10% a year for the client. Okay, you've got to deliver what you're saying you're going to deliver. Risk, now be that market risk, asset risk, leverage all these aspects, they want them to be minimized. Okay, yes, you can go and generate 10% a year if you're investing, if you call it a core European mandate and you're off into Slovakia and markets like that. Yes, you can generate those returns, but it's not what you said you were going to do. So you've got to stick to the mandate. From a client servicing aspect, incredible customer experiences. So they want an easy onboarding process. They want bespoke client reporting that fits straight into their internal reporting systems, which is impossible because everybody has different systems. And this varies by client, but a lot of clients want to visit the assets. Some have genuine interest, some just want to go on a trip. So where are you going to hold your investor days? How are you going to convey the fund strategy to the client? Are you going to have an advisory committee? Are they going to have inputs to the strategy? Are you going to listen to them? Fees, nobody wants to pay fees, which is ironic, because see, if you want items 1, 2, 3, 4, and 5, you've got to pay for them. You're all aware of the massive pressure on fees at the moment. I mean, we're seeing live examples where clients are coming back to us and the fund is performing and it's doing exactly what it should be doing. And clients coming back saying, I just want to reduce the fees, please. So there needs to be a fee system which shows alignment between both fund manager and client. Because yes, you can do something for 5 basis points, but it's not going to be very good. So that's what a client's looking for when they're investing in the fund. If we could deliver every single one of those aspects, life would be very easy. Very easy. But when you move on, and we'll jump on a slide, this is what we're aiming to deliver.
So this is the fund management side saying practically what can we deliver? We want to deliver exactly what our clients want, but there is a spectrum of priorities that they will be putting in place. So it's our job at this stage, when you're in product development stage, listening to the client, finding out what their priorities are and whether that will fit with the strategy. So we need to be able to illustrate very clearly what the strategy is, led by research. How will we deliver and implement this strategy? Is there proof of concept already? Do we already do it and we're just doing it in a slightly different way, in a different structure for a different client base? Or is this entirely new? Do we have a pipeline of assets that's there ready to go? Or is it a black box that we're just selling the dream and we'll get into that when we have the cash? Is there a point of difference or USP that we've got within this fund strategy that's different to anybody else in the market? And why this and why now? Really important questions that you need to ask yourself about what we're going to deliver as a product strategy. When it comes to the team, when you think of the practical realities of any business, I can't think of any fund management, investment management house that has a team waiting to go out and just pitch new strategies. Generally, you will be doing something else in your day job, and this will be a proportion of your time to go out and win this business. Maybe at that point you win it, or you raise a certain amount of money, you can then go and establish a bigger team, a bigger pool. So the track record may be applying to something that's totally different. And if you're looking at a new strategy that's got a unique selling point that doesn't exist in the market, then your track record, by nature of the strategy, is not going to exist. And that's something we've found really difficult in residential investment, is what the future is going to look like in that investment sector is very different to what the past has looked like. So if you do have a track record, is it really applicable to the strategy you're going to put in place? And if it isn't, how do you evidence that your strategy is going to work with the people that you're proposing to do the job? Returns. This is actually a really crucial discussion that you need to understand with the client base that you're targeting for this product, each product. Are they IRR driven? Are they return on equity driven? Do they care most about income and dividend yield? Is it total return? Is it capital growth? Which elements of the return are they most interested in targeting? Because it will vary for every single different client. And even if they're talking about total return and IRR, you might find out that the most important thing to them is actually return on equity. Especially,
there can also be a disconnect between what a client is looking for and what you can realistically deliver within their risk framework. So if you look at Middle Eastern investors, for example, they still refer to investing in core real estate and being able to deliver an unlevered 6-7% return, which, as I'm sure you're all aware, is pretty difficult to do. So you've got this different definition of core plus, value add, opportunistic, depending on the client set. and in terms of what they're looking for. Everybody wants a 15% return on an 8% income and no leverage. That's quite difficult.
We've got a value add fund that we've just launched. It was one of the 3, and that target return is entirely IRR driven, geared return with a base level and then a participation for us over a certain level. But actually, when you see through it and speak to the clients, of which there's multiple, they care about return on equity, and what they want to do is over the life of the fund is double the money. That's all they care about. And because they've allocated cash that takes a while for us to necessarily deploy, that's effectively sitting in their bank account earning 0 or notionally 0 return. But we're only tracking it when it comes into the fund and when it then goes on to earn a geared sort of 15, 16%. But if we're only investing in, say, year 3 and only putting that money really to work year 3, year 4, it's sat there earning nothing for 3 years. So there's parts of the return profile that we don't see because it's managed outside of our fund structure. So it's really important to understand who's deploying the capital, what that capital's doing when it's not coming for us before we call it. Risk, minimise at every opportunity. I mean, that's not 0 risk. If you're having a value add strategy, you have to take risk in order to get the return profile, and there's an acceptance of that by clients. And there's a real interplay between returns and risk. Obviously, if you're introducing gearing, that's an obvious way that you can boost returns, but immediately changes and increases the risk of hitting your return profile. What we're talking about is minimising it at every opportunity, not getting rid of it entirely. So how are you monitoring the risks? Initially, how do you identify the risks that really play on the strategy? Then how do you monitor those as they come in through the strategy and it deploys? How do you manage them to make sure that they are minimised? And if they're not monitored and they get out of line, how do you bring them back into line? How can you evidence that to the clients as you're explaining within the strategy?
And there's certain types of risk which some clients will take. So if you look at a value add strategy, for example, some clients will say, we're not taking zoning risk. Define zoning risk. So the challenge is, and they want limitations put on zoning risk, and say, well, what's the difference between planning and zoning, and how do you fit that into that bucket? So the challenge is, again, going back to the first point I made in the first slide, is that clients don't want any risk. But if you're not taking an adequate amount of zoning risk in a value add strategy, for example, it can be difficult to deliver a 15% return. So there's types of risk that clients are more amenable to. Vacancy risk, the simple ones around whale and that sort of thing, it generally, clients are pretty receptive to that sort of thing. But when you start putting in stuff like zoning risk and speaking to local councils around change of use, that becomes difficult for a client to compute from a value add perspective. And
then on service, that is the bit that should be the easy bit. We do this all the time. We have X billion of management. We have numerous clients, but it's often the bit that falls down and has to catch up once you're into a deploying strategy. This is about how will you communicate, how frequently, how do you communicate on drawdowns? Is it monthly reporting, quarterly reporting? What's in those reports? Is it just an AUM picture? Is it about returns? Is it commentary? And is it presentations, calls? These are the bits that everyone thinks everyone understands, but actually clients have very different requirements. So getting that right, if you want to have a client that's satisfied at the end of the day, because you might be investing great, but if you don't tell anyone about it in the way that they expect, you'll have an unhappy client.
And what clients want in an ideal world, you'd be able to sit in your phone. You could go into the fund that you've invested in. You could go into the building that you own 100 yards that way. You could look at the 4th floor and you could tell me exactly how much that tenant is paying for their rent and when does their lease expire. We do not have the tech platforms to enable that at the moment. You're seeing a lot of the startup firms that are doing this. You'll have seen it, a lot of the blockchain and the tokenization stuff that's going on in the US are starting to offer these platforms, which is primarily targeting retail clients who are very focused on the customer experience. All they want is a headline number that's going to give them 7, 8, 9% and a nice app on their phone to get into that type of asset class. I think we're evolving our client servicing model because institutional clients can access that information at the moment. Right, so if a large sovereign wealth fund speaks to us and says, I need the information, who's on the 4th floor? How much rent are they paying? We can give them that information. But it's bridging that gap from your large clients all the way down to your smallest client, who can then have the same customer experience that the large client are having.
And then fees, and yeah, okay, so no one wants to pay fees, obviously. They want to pay a rate that's fair within a marketplace. Fees plays into many of the elements that we've got here. So if you've got a really strong team and you're delivering a value-add strategy that's across multiple jurisdictions all across Europe, it's going to be expensive to run that team. And there's a reflection from clients that, or an acceptance that if it's an expensive strategy to run, but it's getting the higher returns, then the fees can follow suit. Whereas if you're doing a long lease type structure, which is relatively simple to manage, I need to not talk down some of my colleagues who've got a very successful long lease fund. I don't know what the fees are on that actually.
High.
Very cheap.
Very high.
Yeah, for you, good price. Yeah, so is there a competitive product? That'll influence what fee we can charge. What's the nature of the strategy? Is it very employee intensive? Do we have big teams that need to run and support it? It's going to be more expensive. Is the fee based on, if it's geared, is it based on gross or net? That's an important consideration. And is there some kind of benchmark driven return and then some kind of participation over that? So there's many ways to cut fees to actually play into all of the other elements that we're talking about.
And a lot of the fee aspect is determined by how attractive the product is. Right? If you're trying to launch a sort of Me Too cookie cutter product that somebody else is doing at the same time, or another 3 or 4 exist, where's your pricing tension? You don't have any. You're basically in a race to the bottom. So all the stuff that we are trying to do is, and Ed will come on and talk about a pan-European fund, we're trying to launch things that other people can't do, because that enables us to charge a higher fee. And this is the important thing. This is the selfish slide that we're going to put up. This is the fund manager. What are we trying to target when we're launching a fund? Because let's be honest, we want to charge as high a fee as possible, right, on a really great product that nobody else can do, that we're going to raise billions and billions of euros for. Okay, so what does that actually look like when you're doing what the successful products, and all these questions we've asked you already, we're just throwing questions at you. Where do you get the answers from? You get the answers from the clients, right? And we talk about doing this thing called co-creation, where we're speaking to clients the whole way through. You don't kind of go out to a client initially and say, look, we've got this great fund idea, we've got a fund management team, we're launching it, what do you think? Right? Because it's quite difficult to do. If you're sitting with a client the whole way through and saying, well, we don't like that level of leverage. We don't want to go to Poland. We don't want to go to Czechoslovakia. We really don't like Spain at the moment. You can use that information to help you build the fund as you go through. So the client focused.
Will that be different if you're doing a pooled fund? Because presumably all clients will have different criteria on all of those things that you just indicated.
Yeah.
And so your product can't constantly be moving to
No.
the day.
You're right. And what it is, you've got to focus on the big clients. It depends what you're trying to do, right? If you're going to launch a pooled fund, which you're still trying to get to an initial close, say you're launching an open-ended pooled fund, you're still going to get to a first close of, say, 300 million euros. And what you'll find, if you can build a product which you can get 300 million euros of interest in, then chances are you're going to get more clients that are interested in that. But if you're really struggling to get to 300 million, or you only get to 50 million, the idea is probably not that good.
So you focus on the big ones first.
So you focus on the big ones, on the smart clients, right? They might not necessarily be big. You can go and speak to some Canadian clients who don't have a huge amount of money to put in, but they're really, really smart. If you're talking about doing residential funds, North American clients have invested in residential funds for a long period of time. So they have an awful lot of insight into what they've done domestically. They're now looking to invest in UK and European residential funds. So you can go and speak to them.
Neil doesn't necessarily mean smart. All of our clients are smart, right? He means maybe more open-minded or creative, or maybe have a different investment experience in different jurisdictions.
Thanks for
TM.
clarifying. So yeah, if it's innovative or differentiated, something that other people aren't doing, then it's a lot easier to launch. Less susceptible to in-house implementation. We don't want to launch something that people can turn around in 2 years' time and go, we're just going to go and do this ourselves. We'll take your money out, take the money out of the fund and we'll just go and do it ourselves. So we're trying to do more difficult things. So what does that mean? Cross jurisdictions, multiple asset classes, more operational stuff that Ed can come on to later. Investment capability, we've got to have a team that can do this. As Ed said, we can't go and buy in a team and have them sitting there doing nothing for a few years while we go and get money for a fund for them. Okay, look, we bring in new individuals all the time to launch strategies, but we can't just, no business is in a place where they can just load up teams with no AUM. Attractive economics, we've talked about this already. Attractive fees, it's scalable, you've got a long product duration. I mean, there's no point going to an awful lot of effort to launch a fund if it's only got a life of 3 years. You know, we want big, open-ended strategies. We want value-add funds that sit in a series, so you can get the same client over and over. They have a good experience. They know you can do it. So next time you're launching value-add fund 6 or 7 or 8, it's a relatively short conversation. Marketable, large addressable market. This probably comes back to my smart client comment, but you've got to go. There's no point launching something for a niche client group if you're trying to get scale. Okay, so if the Lithuanian Pension Fund Association, who have 2 billion of AUM, are really interested in a strategy, but they only want to allocate 5%, there's no real point building a fund around their requirements. Okay, recognised brand and reputation. I think we sometimes take that for granted at Aberdeen Standard Investments, in that we generally always get the first meeting with the client. Okay, because we're doing some interesting stuff and we're a big house. We've got a lot of stuff in the UK, a lot of stuff in Europe. We can almost do anything in the UK and Europe. So we tend to have the initial conversations with the clients relatively easily. But it's the follow-on from that. And it's identifying those potential cornerstone clients. Because if we don't have the cornerstone clients, then, as I keep saying, from an internal perspective, there's no point keeping going and going and going. If you can't get to 100 million, the chances of you getting to 1 billion are pretty slim. And client relationships and re-upping of clients, that is really based around customer experience, which we talked about earlier. If clients are having a good experience with you and investing in your funds, they will invest across asset classes, across funds. And that's a big thing for us at ASI. It's making sure that our clients who are investing in our long lease funds are looking at our residential funds, are looking at our value-add funds.
Have you ever had to abandon a product? Have you ever got to a point where...
So my job is to make sure we don't get to that, because I'm sure there's lots of people in this room charged by the hour on launching one of these things. And if you're going to sink in $250,000 of costs and then suddenly turn around and say, we're not going to do it, you can't do that all the time. And look, yes, you're always going to get stuff which for some reason doesn't work. I mean, I'm not going to lie to you and say everything we've ever done has been fantastic, but it's my job to make sure that we're not, every fund doesn't get £250,000 spent on it before we go, oh, we're not going to do that.
And that's the more important point. So you don't want to cut down ideas across the house and the business, people having good ideas and promoting them, fine, but don't go, spending a lot of money, wasting a lot of time before you realise it's a good idea, but it's not going to work. So it's stopping it very early in the process is part of that. I've worked on...
Lots of bad ideas.
Lots of great ideas, thanks Neil, that for whatever reason...
Before their time in the market is the general excuse that people throw out. Yeah, the market's not ready.
But that we've abandoned pretty early because we just identify, right, where are the key parts. And I think the most important part of all of this slide is the cornerstone investor. Yeah. What we're talking about today is product development. So working as a team across various teams, and that client becomes part of the team. Whoever that cornerstone client or collection of cornerstone clients effectively becomes part of the team. Because if we get it right for them, the likelihood is that it will work for others, and you'll build that momentum. And when people are taking a leap of faith about which fund strategy to choose, one that is already has scale, which helps their liquidity as well, if it's an open-ended fund, has scale, has a proven track record, proof of concept, they're going to go with that one versus one that's yet to get off the blocks.
So the compelling event for you is going out and testing the market, soft marketing?
Yeah,
We
identifying that.
generally know, I mean, look, we've just gone through the factors that we generally know what clients are looking for. I think it's the deliverability. And we are not short of ideas, right? We have research teams and a lot of smart people at ASI who are constantly generating ideas. Some of them are crazy. Some of them are really good, but not deliverable from a client perspective. You've got to remember there's a difference between a research thesis and being able to deliver a product at the other end.
That's going to make money.
That's going to make money. I mean, yeah, it's selfish, but it's got to make money.
Yeah.
Otherwise, we can't have the fund managers. We can't do the client servicing. You're not going to be able to deliver what we said we're going to deliver.
So then almost just summarise on those 5 points.
Oh, me.
Your top one.
So we've kind of gone through the majority of things. I'll maybe take you through the kind of things we're seeing in the market at the moment. From a thematic perspective, you all know we're relatively late in the cycle. So going out and launching sort of generic value add market timing funds at the moment is quite difficult because assets are quite expensive. You can do things which are a bit more alpha driven around the residential space. For example, we've launched a value add fund which is really just targeting office conversions in continental Europe. So buying effectively obsolete office space and converting it into residential. So you can do these really, I hesitate to call them niche because they're still scalable, these really focused, targeted strategies at this point in the market. ESG. Everybody wants ESG. And quite frankly, the way we look at ESG is it's just inbuilt into all our funds. It's what we do. We're constantly facing this dilemma. Do we launch an impact fund? What is the definition of impact? Okay, is impact actually just putting grass in the roof and reducing the electricity consumption, or is it actually putting a library into the ground floor and charging them no rent? If you're going to put a library into the ground floor and charge them no rent, it's going to impact your IRR. Other things I will draw out here.
Well, I was going to say that, on the team side, so when you're talking about, if you've got a strategy that's trying to look different, and like late cycle, all of our strategies need to look different because there's well-established funds pretty much doing all of the core stuff. So then you come onto a track record and you're going, right, well, we're going to stumble around for a track record because by nature this is different. So there may be other things that you're doing across a house that you can realise you can actually tell quite a compelling story. There may be assets that sit within a seg mandate or a different balance fund that actually play exactly to this strategy, but you just need to tease those out. And that's the same with the track record of the individuals that you're employing. So it's be creative about the story, the themes that you're starting to play. We are actually the third largest investor in student residential accommodation, but no one here would think that. That's not something that we necessarily flag. We don't have a student accommodation fund, but we've got 6,000 student beds. So how do we use that to tell a story about our understanding of the student accommodation market? How many people work on the fund, key men, that all then plays into fees and alongside all of that.
And it's interesting that the how do they get paid aspect. So we're in the process of launching a value add strategy at the moment, and we spoke to one of the smartest investors on the planet, who somebody in this room works for, but I'm not telling you who. And we summed up and we did 5 hours of DD in a very hot room in Paris. And the one question they asked at the end, and they pointed at the fund manager and said, how do you get paid? And the point of the question was, unless you've got a value add fund manager who is absolutely aligned with fund performance, who's going to live and die by what happens with that fund, they don't believe that you've got proper alignment. It's not about how much are you getting paid, it's are you getting paid if this fund performs. So it's absolutely key that the team is aligned and set up correctly to deliver fund performance. Otherwise, quite frankly, you're kind of wasting your time.
Do you guys ever need to do market scoping in terms of what your competitors are looking at? As in, like, for example, on the impact fund, many of your competitors are looking at that. Presumably you guys are also thinking we need to do something similar, or I don't know.
Yeah, so we do. I mean, we're looking at stuff all the time. We've got a team of people whose job that is to work out what other people are doing in the market. In an ideal world, you'd have everybody else's presentations, and You can't get them. I mean, we don't put ours, you can't go and find our value add presentation. It's very difficult to find that information. There's ways to find them.
I would hope.
Well, sometimes leave them sitting around in coffee
Yeah, if you
shops,
Google it, actually, sometimes it comes up.
there's ways to find them. You know, a lot of the US disclosure, for example, has to all go online, so that there is routes to finding information about what other people are doing. There's service providers such as Preqin you can sign up for who give you market information, but you're always a little bit unsure because you can't get that perfect level of information. But yeah, look, the same thematics we're looking at, our competitors are looking at as well, but you've got to deliver something that's compelling. Okay, so that when you forget, when you're going to visit a client, the next 3 people in are also trying to do the same thing.
And sometimes you can just tell by body language. If you're saying exactly the same as someone else has said, and it's the 3rd time they've seen it, when their shoulders drop and they start playing on the phone, then you know
So if
you're probably the 3rd person to say exactly the same thing.
So by the time you go see them with a new product, presume and you realise that someone else already has the same product, you're probably 12 to 18 months behind. How do you avoid that situation?
We wouldn't do, I mean, this comes back to your kind of the point I made on fees. If you're trying to launch a cookie cutter Me Too, it's going to be really difficult. I mean, you try to avoid that situation all the time. Sometimes it's impossible, but you've got to identify where your strengths as a business sit. So if you look at our residential franchise, for example, you know, we're just about the best out there in terms of track record and AUM and that sort of thing. So we can do things, I think we can, I mean, biased point of view, I'm sure somebody in here will tell me otherwise, but I think we can do things that other people can't do in that space.
But it also comes back to that cornerstone investor and getting them involved as early as possible. So you're not 18 months in, having spent loads of money on structuring and think you've got the ideal product, and then you go and see a cornerstone investor who're really excited and they go, no, we've seen this 5 times already. You will come on to when you do things in a minute. Yeah. Just flicking over this. So then risk, it's in its context, you have to remember that, and it's about identifying, measuring, managing and resolving. How do you make sure you do those things within your strategy? The other 2 bits are, I suppose, profitability. If it's not making any money, it gets canned quite early on as well. So then the fund timeline.
Yeah, so this is a very, I wish it was this easy, very simplistic way of showing that. And you can see the external networks and that client aspect comes in very early. Some of the best products we've come up with have actually been conversations with clients. You know, they've got a problem they're trying to solve from a risk perspective, a return perspective, a liquidity perspective. So these kind of co-created products are some of the best things we've come up with. We then go into a phase, you know, we do that active research. So if you think of it from a funnel perspective, we might have, we've probably got 50 fund ideas across the house. I would say we've probably got 10 realistic ideas that we look at from an active research perspective. We then go into design and test. We're having a conversation with the client. We think this could work. We think this makes sense. We've got the capability to deliver it. This is the returns. This is the fund model. This is where we could source assets from. The development phase, and the huge teams of people within ASI that do this, the development phase is around your fund structuring. How would we deliver this to the clients? Who are the likely clients? Your fund, I mean, you guys have had 2 lectures on this already, so you're, from a development aspect, the type of client you're putting into this really does drive the fund structure. And
it's at that point that you probably start talking to the market that you're looking to invest in to try and secure the type of assets that you want. Because you can't just go, right, fund launch, right, hit the button, let's acquire some stock. It doesn't work like that. And there's a real interplay between being in the market, talking to competing investors and getting product, and talking to the brokers and the agents and getting the product in, and being able to explain what your pipeline looks like. The dream scenario is that you've got a portfolio in exclusivity that exactly plays to the strategy. So as soon as you get your first close, you do your first deal, the next day. That can depend on how you as a corporate are prepared to upfront the legal costs of that and maybe underwrite deposits, etc. Which
and we've done that sort of thing. We have launched products off the back of specific opportunities. It's got to be relatively large, obviously. You're not launching it off the back of 20 million worth of Southeast offices, but if you've got large portfolios which you have an angle on, or a vendor's looking for an exit, we have structured products around that. And then obviously you're into launch, growth, and if you're in an open-ended pooled fund, hopefully this is a long way off, but at some point you reach maturity. Is there changes to product features? You will find that as you reach maturity, there's more competition in the market. Fees might have to come down. You might have to broaden the mandate slightly, but all that's done in conjunction with client input, that external networks aspect. And then decline. Some open-ended funds just go out of fashion, unfortunately. People take their money out. The requirements of the client at the end change. So they want to do something different. Hopefully by that point, you've got something else you can recycle their capital into.
So how does that actually work in practice? So just on the next couple of slides, we're running a little tight for time, so I'll spin through it. But this product is a product that is unique within its marketplace. There's always going to be different views on how unique it is, but the reality is there's no fund that's truly achieved any kind of scale or diversity in terms of a pan-European balanced product. There are investors who have access to a couple of markets. The UK is a relatively embryonic residential investment marketplace, but somewhere like Germany, across Scandinavia, has a much more investable marketplace, and there are people with real scale in a single jurisdiction. And when we started talking about leveraging the fact that we've got, well, at that point we had 15 offices across Europe, real boots on the ground that were all doing residential investment of some form, how could we get all of those to collaborate into a single product? The first couple of investors, well, one investor was absolutely forthright that we would not and could not make it happen. It was too complex, too much currency risk, too much regulatory risk. There was no way we could deliver it at a fee rate that would mean that the income return was even close to being, above zero, basically. So that was quite a challenge. It is a compelling strategy when you play to the urbanisation story that's happening, playing into alternatives, playing into very solid, secure income, low volatility. But that client in particular said it wasn't possible. But the second client that we went to see said, we've been thinking of exactly the same thing, and we can't find the right party to develop a fund to do it. We explained exactly what we could deliver, and they decided, yeah, let's go for it. So one key cornerstone investor that was also responsible for doing due diligence of a sort of fraternity of investors that were Dutch investors. So we closed last March. We had an initial close, I think it was 280 million. We can gear to 30%. We've had 3 subsequent closes. So single cornerstone investors. The first close had 4 investors in it, so 3 other investors. 2 were sort of partner investors of the cornerstone investor, and then another that came in and ran all of their own due diligence and nearly upset the apple cart at the 11th hour. But we've had 2 further closes. We've now got 540 million of committed capital. We've already deployed all of that. It's allocated to deals that are under contract. So within a little over a year, we've deployed all the committed capital, and we've now got a further 250 million euros in due diligence, and we've got the pipeline pretty much closely secured for that. We've got 370 million pounds of assets in the pipeline. That's a lot quicker than I thought it was going to be, actually. But
this is an example of a successful fund that is it's early to market. And look, people will probably there are other funds that are doing the same thing. But as you start to get that scale, you give that diversification, you give the advantages to clients, so therefore there's more benefits to being in a larger fund. So this comes back to your point that you made around, other people are doing this, right? And we're all speaking to the same clients, and we're all up against each other in terms of proving, right, who's got the best capability, who's got the best team, all these sorts of things. So you've really got to make sure that you're very competitive versus other people.
And the momentum, and I think the most important bit we have at the moment is proving that the concept fits exactly with the strategy that we've employed. That's a little difficult when we're aiming for a fund that's going to be circa 5 billion, 3 to 5 billion is the anticipated fund size. So when you're early stages of that, you're going to have assets that look very big and unwieldy in a 300, 400 million pound portfolio. So there's a real balance to play, but you have to look at that at least medium-term position and acquire assets that fit the strategy that you sold and the portfolio that will look right in sort of 3 to 4 years. And what we've found is that the compelling story, the proof of concept, and the fact that we're deploying exactly in line has meant that our subsequent fundraisers have been much easier and, in the last case, much bigger. So we're finding it easier to win money rather than harder. And yet there are now 2 competitor strategies. They're slightly behind, and because they haven't been able to deploy in the same way, they're still sort of saying, just believe us, we will invest in the way we're saying, whereas we can say, don't believe us, look at what we've actually done. Come and have a look at the assets. Meet some of the tenants if you want.
The increased fundraising size, is that predominantly investors re-upping with greater capital commitments, or are you getting traction in the market off the back of?
We've now got 20 investors in this fund, and there's another 5 that are in DD. So it could be 25 from 4 a little over a year ago. Yep. Those 3 of the initial 4 have actually got a much higher allocation to the fund, but they've got caps on their proportionate amount. So they'll only up when it goes over a fund size of $1 billion. They come back in again.
And there's certain clients who won't allocate to funds under $1 billion. It's just they won't be more than 10% of the fund, and they won't go under $1 billion. So and that when you start moving to the overseas guys, that tends to be the case.
So that momentum, but it really comes from getting it right with one client that is going to be committed, that also understands what other investors are looking for as well, because they want the scale as well. It works for them. Yeah. They get a great fee rate because they're the first one in, they've helped design it, and they want to know that it's part of a large established product. And also they've got their career satisfaction as well. When you're talking about an individual person that wants to be able to say, and when they're bouncing their grandkid on their knee and boring them to tears, go, yeah, that Aberdeen Standard Pan-European Fund, I was part of that. No, but the job satisfaction of being able to go home and go, yeah, we did that. You know, I was part of something that was deemed to be impossible. And so there's a part of that plays into it as well.
And will you regularly get squeezed on your fees pre-first close, or not really?
There's only a certain, you've got to charge fees on this at some point, and it comes back to that. Yeah, you can try and squeeze us on fees, but this is what we need to charge for this to make money, to make sure we've got our best people on this, so you get client servicing. So no, this is a good idea, and we're pretty robust on fees on it. You get discounts on fees. If you're chucking in 200 million euros, right,
it's more
you get
about size now.
Fees. But don't expect, if you're rocking up 25 million euros, to get a discount on fees.
Are you guys taking operational risk? As in, are you going into cap?
No. So we are taking operational risk because ultimately they're operational assets, but we're not going further into that operational and principally the sort of HR part of care and extra care. So there is operational risk, but it's not at that yet. Yeah. Not that level. Okay. So we'll be taking questions at the end.
Yep. There's questions on if everyone's logged into Slido. If you don't want to stick your hand up, ask questions and we'll address them all at the end.
Great. So at this point, I'm pretty sure all of you who've been to the various sessions are pretty lawyered out by now anyway, so I promise you that I'm literally here just as a bit of fluff at the end to bring a few things together. Ed and Neil having produced some really interesting stuff following that is difficult. But I think what it usefully does is bring the whole series together. The first of the sessions was talking about what funds are, the structures, what they look like. The second part was the tax and regulatory pieces that went into it. And of course now Ed and Neil have very usefully, that's the stuff that we then plug into those structures. That's why those structures work. That's why they're designed, is because these guys have gone out, done the hard work with the client, and worked out what works and what they want to do. So moving now to the point at which we have our fund, we know what the clients want, we're ready to go, we're ready to launch. We go back to the theme of the whole series, which is effectively all of you work in your individual roles, whether it's an investment analyst with a manager, or whether it's a finance person within a deployment team or otherwise. And often these are in big organizations, and you forget that there are a number of other pieces that have to continue to work to get these things off the ground. So the first thing is, I don't know if the Slido is going to work or otherwise. I'm looking at Tom and he's grimacing. The question effectively was what are the important things about launching and deploying a fund? And it was an idea of there are a number of different answers there, and the point of it was there are a number of things to consider, and it's about prioritizing what you would think about. The first point is really just a statement and a reminder. I'm not going to talk too much about it, but it is just a reminder that just because you're ready to launch your fund doesn't mean marketing go into gear, investor relations go into gear, and step away all other advisors, leave us alone, we're good to go now. There is then a hell of a lot more that needs to be done to ensure that the launch goes smoothly, and also then when you're ready to start spending the investors' monies, that the deployment of the capital is effective and achieves ultimately what you're trying to do for the client. We're going to look at sort of planning for those two events, launch and deployment, a couple bits on the investor negotiations, and then right at the end how you sort of just to think about when you exit. So the first thing is, what do we mean by launch? Well, launch we're talking about is not necessarily in the context that Neil was talking about, prepping a product and having something to go to market with. This is, we've gone out, you've done the hard work, we all know what the cornerstone investors want, we've created the structure, we're ready to go, now we want to take their money. That's what launch is when I'm talking about. And unfortunately or fortunately, fund structures have got so big, clients have got so sophisticated, lawyers have got more and more involved. It means that these things are not easy. And there are a couple of key parts to it that you need to think about. Now, you'll notice in there terms that I've deliberately lumped open and closed-ended funds together, just to bring out some of the ideas rather than trying to focus on any specific thing. Documentation for your launch is key. As you'd expect, everybody wants to know they're protected. The investors want to know what they're signing up to. We want to make sure we know what's expected of us as the managers, and we need to make sure it all works. We also live in a highly regulated world. We need to know that the investors are kosher, where their money is coming from, all those various things. So the suite of documentation has increased exponentially through the years that funds have been in development. So getting those things in a line, having everybody on the same page, particularly when you're talking to cornerstone investors ahead of time, ensuring that what they finally invest on is the final version of the thought process is very important. Do you have everything you need from investors? That's the regulatory piece, the CDD. It ties in a bit with who is investing and how. Many of these big institutional investors have pots of money. It is not as simple as Primerica investing in a particular fund. It is going to be some weird subsidiary somewhere else that has 50 million that they want to put in. There's another subsidiary with another pot of money that wants to put some more in. And it's coming to the point where you understand who that investor is and where their investment is coming from. The process. This is the mix between open and closed-ended funds. You need to establish beforehand how you expect to take investors' monies in. Is it going to be a single big bang, a single and final close, where in the context of a closed-ended fund where everybody comes in, that's it, away you go. Dry closes, soft closes, multiple closings, continuous subscriptions in the context of open-ended funds. So again, identifying the closing and the initial launch process is pretty important. And the who is investing and how. Institutional investors in particular have just got so much bigger, and they're carving up their available assets, their available investable monies into several different parts of their business, all of whom may have an interest in the particular product that you're launching. So it's important to get under the bonnet of the institutional investor, so to speak, and figure out where their money is coming from within their institutional entity. And also, in the same way as the fund structure is designed to be efficient financially, the way investors invest into these funds is also designed to be efficient. They're going to want to use particular types of vehicles to come into particular types of funds. So it's extremely important to understand whether you're going to need additional vehicles for investors to come in. Pooling vehicles, blockers, nominees, parallels, all those are terms that you may see in the context of big institutional investors. So those are a couple of the points on launching the fund. In terms of deploying capital, we've got all the money in, we've got all these great ideas now, and we're now ready to spend the 300 million that Neil has raised on his first close. How do we go about that? Well, the first thing is just remembering what our structure is, remembering what our strategy is. Neil and Ed went through a very interesting slide on how they get to these things. This doesn't then go into the cupboard, never to be looked at again. It's a very important part of the ongoing process. There is no point having this wonderful opportunity in a commercial arcade in Prague when your fund is a prime central London property fund. Yeah, great, but it doesn't fit. That's not what we told investors we were going to be doing with their money. And you'd be surprised at how often that happens. Not as extreme as that, but there is a lot of strategy creep that happens when you are beginning to deploy your capital, because a lot of these deals are relationship driven. And somebody comes to you because they know you have access to money, and they present a deal to you that looks really good. It kind of fits in what we do, but we've got to seriously look at what the strategy it's set out to investors is before we go off spending money. We then move on to how are you going to acquire it? The acquisition structure. It is not a case of see property, buy property, book property. You have to think about how you hold it. Is it going to be held in an efficient way? Income coming in from the use of the property, how is that going to find its way back to the fund and out to investors? When you're getting ready to sell it, is it packaged in a way that will make a sale easy? So the acquisition structure needs to be thought about right from the start of your deal-making process. And this is where you go primarily, I guess, to your tax accountants, your advisory accountants, looking at structures, and that's where the holding entities come in. You may be injecting intragroup debt into it, so financing entities become important. You may be taking properties that you're going to be running, servicing. You may have a lease servicing entity that goes in there, sale and lease back arrangements. Any manner of complication can be in there, but you've got to think about how that's done. They're often not done through a single holding company or holding vehicle. There's often a structure that goes with it. The payment structure for the acquisition is really important. Again, gone are the days of see property, hand over cash. Management participation in the context of buying businesses has become a big part. You want to keep the management involved. Often we don't want to hand over a huge slug of cash. We want, Neil was talking, I think, earlier about ensuring that there's an alignment between people. So we want to make sure that actually the owners of the particular property, business or otherwise, don't sort of hand it over and walk away and take with them a lot of institutional knowledge. So there are earn-out elements. There are options to convert debt to equity or equity holdings into other things, and deferred payments, all of which need to be considered. And then finally, in the acquisition bit, the funding flow. All the money is sat in a bank account in the fund. How are we going to get it down in an efficient way to the asset? Are we just handing over cash? Are we doing some sort of debt equity splits, convertible loans? Are we going to get external bank debt to leverage the returns on the asset? So again, all very important to remember. And then, as silly as it might sound, at the point at which you're about to buy an asset and that you're going to hold this asset for 5 years, 6 years, 8 years, however long you hold it, to be thinking of the exit seems odd. But there is no point spending a hell of a lot of money on the billable hour people mentioned to get the acquisition structure in place, only to find that when you come to sell it, they're going, yeah, I really love the asset, but I can't buy it the way it looks. And the returns don't find their way back to the fund in an appropriate way. So anticipating your exit is pretty important. And you don't have to identify a buyer, you don't have to identify a particular form, but having some idea of how you expect to exit the asset is pretty important at the start of the process. doing a deal to do a deal. At the end of the day, you're having to do a deal with the investors to get them in. This usually is primarily in the context of closed-ended funds, or indeed even when you're launching open-ended funds right at the start with your cornerstones. And even though we're talking in the same group, we didn't actually look at each other's slides too much. But you'll see a lot of these do track what Neil and Ed were talking about, that they speak to investors about and what's important to them. Fees clearly at the top of things. The waterfall, the returns. What is the client expecting to get back? How is he expecting to get back? Is he happy to get bits first, and then the manager takes his bits, and then a bit more, and profit at high watermarks, all these sorts of things. Setup and ongoing costs is important. I won't go through all of them, but those tick off quite closely a lot of the things that were talked about in dealing with the clients. Divorce proceedings, we're not slipping into Love Island or any of that. This is actually talking about how the investor and the fund part ways, or the manager and the fund part ways. Again, pretty important, particularly in the context of key person risk, key advisor risk. How do we, if this isn't working, how do we all step away from this without losing a lot of money, losing a lot of face, losing reputation, etc. So that's usually a big part of the negotiation process that we see as the lawyers in terms of the documentation. And then the final point is really just to make it bigger and bolder about the last thing you need to think about in deploying capital, which is how is the story going to end? Anticipate your exit and ensure that what is happening from the bottom back up meets with the thought process right at the start. So that's it really. I didn't want to take any more time than that. Apologies if it's a whistle stop. So I guess we are now open for questions.
Yep. There is a mic if anyone wants to stick a hand up. There are some questions, Ed and Neil, these are probably aimed more at you. I'm going to be selfish and ask first. There's a question about Brexit and how late we are in the cycle. Are you guys seeing money coming to the UK still, or does the UK, particularly prime central, your primary cities, have you seen a slowdown? I know I've got a view working for an administrator. I have a view on this.
It depends. I mean, try and separate late cycle and Brexit and all this sort of uncertainty. I think what you can say for sure is there's an awful lot of money on the sidelines for the UK, and if something was to happen, if for whatever reason, if we'll get phone calls every week saying, you've got any assets you want to sell at a 30% discount? Not really.
Case in point, on the fund that Neil was sat in a hot room in Paris, it's a pan-European strategy. It specifically excludes the UK as a result, really, of the uncertainty. I would say that's what's driving that
Because
decision.
we might do something that specifically targets the UK. So we'll take, there's two sides to every coin.
Yeah,
but I think
that's the spin. No, the first product that's
you can see we disagree on this one,
yeah.
right?
In the pan-European residential, we've got a limitation on any country across Europe outside of Germany at 15%. The reality is we're going to allocate about 5% of it to the UK. And when we're talking to new investors, it's probably their second question. How much allocation do you see going to the UK at the moment? And if we delivered a pipeline that said, we're 30% UK, we wouldn't have had the investment raise that we have. So it's, yeah.
But on that, have you seen increased, any money that you have got going to the UK, have you seen increased competition for assets from overseas investors in light of the devaluation of the pound?
There's a lack of stock, to be honest. There's not really much around. We're speaking to some Asian clients, for example, and they're saying, right, we'll look at stuff in the UK, but it's got to be trophy. And I suspect they also want it for a 15% discount. And
I think there's too much emphasis placed on the weakness of the pound and the relative weakness of the pound, because foreign investors, if they've got a very clear real estate strategy, they won't be taking currency risk. So they'll hedge it. So they don't get the quid pro quo anyway. It's actually just expensive. If it's more volatile, the hedging cost is higher. So it's more expensive, irrespective of whether you get more bang for your buck.
Depends who it is.
Yeah, there are some that go, well, actually we've got a diversified portfolio, so we take it without hedging it.
if you've got your Hong Kong, your Chinese investors who are far more opportunistic in terms of the way they look at it, then they'll monitor the weakness in the pound. If it's North American clients who are taking a longer term view, then it's less of a...
Because a lot of the, like you say, the trophy assets in London have changed hands over the last, since June 16. The Leadenhall, Bluefin, a lot of them have changed hands. Is that because of the increased interest in the UK, or is that the weak pound, or a mixture of factors?
Different motivations for different people. I mean, there's a diversification of currency exposure. If you're a Chinese investor or a Hong Kong investor, you're trying to get your money out of the Hong Kong dollar just into anything but. There's been a bit of that. There's been, we haven't really seen the Aussies this cycle. After last time, they haven't really come back. So it just depends who your client base is.
And a lot of those aren't domestic sellers. It's foreign capital to foreign capital. So it's not necessarily a play on that per se.
People are very comfortable with the UK as you guys all know this, right? People are very comfortable with the UK as a concept and as an investment location. It's not I don't think that will change. But if anyone's got any buildings for sale at 30% discount, then let us know.
Yeah, let us know just after.
There's two questions, both on sustainability, climate change. I know it's something that we, as a committee, we've actually talked about. I think we're looking at rolling out an event later in the year on this. Have you seen increased scrutiny from investors? I guess on the top one, on climate change, climate risk. There's talk of assets being in a flood zone and so on. Have you seen more scrutiny on that? And then the second part to that is obviously social impact and ESG.
The top one, we just do. Right, across our funds, ESG is now, we've got a dedicated ESG team. I don't think if clients were to come and say to us, what are you doing? Are you doing anything ESG yet? And we said, no, I don't think that's a good answer. So what you see, we've got an ESG framework across our funds. Are we going to do something that's specifically an impact fund? Potentially. But you've got to ask yourself, does the market actually just miss out impact? Right? At the moment, people are saying, let's do a specific impact fund. But does that actually just get missed out? And does this enhanced ESG overlay just become standard across all funds?
And our ESG overlay is embedded in our investment process now. And that's a change that's happened in the last 18 months. But we're not going to acquire assets that we think don't fulfill those criteria. And it's partly, mentioned risk. We haven't talked a lot about risk, but when you're talking about identifying what risks sit with a strategy, any strategy at the moment needs to show how it's dealing with climate change, and that the investment market, as it changes, as increased regulation on what you need to do, delivering just on an EPC level potentially, you are de-risking your asset if you can show you tick all the boxes on an ESG. And if you're not even considering it, then you are blindside, or you've got a blind spot to a major risk. And you've got a huge liquidity risk potentially as you're trying to exit the assets, as Andrew talks about, and you're going, where does it sit on an ESG basis? We don't tick any of those boxes. But it's on contaminated land, it's whatever it is.
So ESG aside, things like, I know we talked briefly about, there's buildings that have been insulated now for our current temperature, but in 5-10 years' time, these buildings might be too hot. There's increased natural disasters every year. So, is there an insurance risk there? Are these buildings going to be uninsurable? Have you had any of this yet? Or is that...
That's part of our process. We explore it with the ESG team. We look at they look at every asset we hold. They look at every asset we propose to invest in.
And is this something that you guys are doing, or is this coming from your investors?
Oh, it's both. We've done that long before. It just comes back to the value of the asset. If you're on a floodplain, then... your 5% cap rate has probably always been a 5.5.
But what is currently what's currently not a floodplain may well be a floodplain in 5-10 years.
I think if you look, so Dutch clients, for example, read into this what you like, but Dutch clients are very, very ESG focused. So I guess that's probably your answer.
Would you forego financial return for ESG stuff?
Would you? Because would you?
Well, we are definitely hearing investors want specifically in your performance objective return as well as ESG performance. Because I would say what you're saying, as most institutions say, is that it's embedded in the process. But embedded in the process is not saying it's a priority, it's just that's the process. Right?
But Neil's point here, right, so floodplain, retail warehouse park in Carlisle that nearly got washed away 2 years ago, that's now 10%. So do you buy that? For us, that would be, no, that's out. But for most investors, that's out. So you could say you're foregoing return because you're not acquiring that. You're acquiring the equivalent product that's not on a floodplain that's 7.5 to 8%, you know, an identikit product. So in that way, are we foregoing return? Yes. But then there's other bits, which would be, you're refurbishing a building, the units that you're putting in, are they, you know, chilled beams, or I don't know, I haven't worked in offices for 5 years, 10 years, but is it chilled beam, which is more, you know, sustainable, or is it actually the most aggressive, you know, pollutant out there, and the cost differential is 5%? That comes down to the economics of the asset, but that's when you're looking at, well, the liquidity risk and also the demand from an occupier perspective. You need to go, yeah, we've ticked all the boxes. So I think there's always an argument to be able to say, we wouldn't do that because it's too risky and it doesn't fit this fund strategy. Whenever it comes to, even if it's cheaper and delivers a better return on paper, if it ups your risk budget, we're unlikely to do it. So it's never quite as, that's cheaper, let's do that one, if that was more what your question was aligned to.
We're finding a lot that people, where we are required to do certification or make it environmentally friendly building, it doesn't stack for us a lot of the time, but we still are being told, you know, we probably should be doing this, because actually some of the value you get is in 10 years' time when all buildings will be BREEAM.
Yeah.
Yeah.
Or you end up with the exception where it's not, and guess what? That's got a 50-point yield premium as a result of that. So I think that's going to play out in the economics.
And I think that's the bit that people aren't quite there with yet when you say impact. So if you're launching an impact fund, for example, value add, you want 15% as your target return, but if you actually want to have genuine impact in there, your 15% becomes 10%. So you have to forgo those financial gains. And this does happen to an extent. There's non-financial gains. And some investors are okay with that. Not a lot yet is probably the answer. But more and more people are coming around to it.
But I guess if you're a core investor and you're only getting 5% anyway, and you also get some social impact, you would have got that 5% return in any fund.
But how much risk do you have to take? Right, it's the risk in the assets. So if you're taking, say 15%, you're trying to target 15%, you've got to take more risk to get there,
Totally,
and then you're knocking it off.
It's really high, right? As in that for core investors, they're probably only targeting 5 now.
Yeah.
And they could also get ESG and social impact performance. Sounds like quite a good proposition.
Would be a very good proposition. Are you interested?
Yeah, pan-European fund does all that. Yep. The other one, I guess it's not their typical time frame. We disagree on this a little bit.
Because you constantly ask me.
Yeah.
It depends how long. I mean, if you've got a client lined up, you've got the money. The money's the hard part.
I think that's not quite right. Bureaucracy gets in the way of everything. It takes a lot longer to get through this process. The bigger the corporate you work for, the longer it's going to take to actually get people to say, yeah, that's a good idea, that's a good strategy. How many committees have you been through? If you haven't been through 5, you probably haven't been through enough. So I think if it's a good idea that's got real scale, it's going to take 2 years, I reckon.
But on the flip side, if you've got your ducks in a row, it's days, right?
On the other way around, yeah. So we dealt with a portfolio in the summer. The product was there, so we were aware of a seller, a fairly motivated seller, which had a very interesting portfolio of assets. And we turned that around 6 weeks.
Yeah, if your capital's there, your assets there, your lawyers are in place, your admin's
Yeah.
in place, it's good. I'm conscious
But
of
that's
time.
rare.
Has anybody got any other questions while we're here? Good. Like I say, the ESG social impact piece, there is an event that we're working on towards the back end of the year, which will be something joint with BPF. So there'll be an invite coming for that. One more thing that I wanted to mention. AREF as a whole, there's an initiative undergoing at the moment to get more FutureGen representation on our committees. So there's a couple of committee members in here from the AREF FutureGen committee, but we'd also like to get some of this network onto some of the wider committees. So Anne, for example, sits on the ESG committee, and if anybody doesn't know the various committees, come and speak to me afterwards. But there's about 8 or 10 AREF committees, and it'd be great to get some representation from the FutureGen network on those. So if you've got interest, drop me an email, come and speak to me afterwards, speak to one of the guys in here, and let's chat about it. But thank you all for joining. See you next time.